Picture this. Over the next 5 years, we're pouring more than $5 trillion into AI infrastructure. Data centers that'll eat enough electricity to power entire countries. The total bill could hit $10 trillion. Here's the kicker. About half of it is borrowed money. Companies are issuing bonds worth tens of billions just for AI build-outs. Meanwhile, NVIDIA's stock trades at 50 times its annual profit. OpenAI's valuation? If it went public tomorrow, it'd rank among the most valuable companies on Earth. Some people look at this and see the mother of all bubbles, a speculation frenzy that makes the dot-com era look quaint. Others see the opening act of a 20-year supercycle, a fundamental transformation that'll reshape everything. But here's what almost nobody's discussing. What if AI, crypto, and debt aren't three separate stories? What if they're three layers stacked on top of each other, each one amplifying the others in ways we're only beginning to understand? Let's start with the AI money. Projections show data center spending hitting multiple trillions by decade's end. The big tech giants plan to drop over $1 trillion in just the next couple years. The bull pitch sounds incredible. Generative AI could create tens of trillions in economic value, with a huge chunk flowing to American companies. That's the story Wall Street's selling you right now. But look closer at how this is getting financed. We're seeing an 80-20 split, 80% debt, 20% equity. Those bond offerings aren't outliers anymore. They're the template. And if that ratio sounds familiar, it should. It rhymes with the circular deals from 1999, when telecom companies lent each other money to buy each other's equipment. The illusion of demand, funded by borrowed cash. Sound familiar? The Magnificent Seven: Apple, Microsoft, Google, Amazon, Meta, NVIDIA, Tesla, now account for the lion's share of AI infrastructure spending among public companies. Their valuations have broken away from the broader market, trading at multiples that dwarf average stocks. Sure, optimists will tell you that's still below dot-com peak levels from 2000. Technically true, but here's what they're not telling you. Concentration is the real story. The top sliver now represents nearly a third of the entire S&P 500's market value. AI stocks dominate the index in ways we haven't seen since the late 90s. The skeptics have their own data points. One recent analysis examined how stocks move together. During the dot-com bubble, tech stocks actually moved independently, each company rising or falling on its own merits. Today's AI stocks? They're moving as one synchronized block, rising and falling in perfect lockstep. That's not innovation being priced in. That's momentum chasing momentum. And there's this phrase appearing in research reports. The idea that we're hitting diminishing returns on scaling, that throwing more computing power at the problem isn't delivering proportional improvements anymore. But let's give the other side their moment. The counter-narrative goes like this. AI isn't a bubble, it's a scarcity supercycle. Unlike dot-com companies burning cash with no revenue model, AI firms are posting triple-digit revenue growth. Real customers, real contracts, real money changing hands. One prominent tech investor frames it this way: we're at the beginning of a multi-decade cycle, not the end of a 2-year hype wave. The investments are justified, the transformation is structural, and comparing this to 2000 misses the point entirely. 10 years ago, you'd have been laughed out of the room for suggesting companies would spend trillions on data centers. Now it's just Tuesday. Who's right? We'll find out soon enough. But either way, this is your money now, your pension fund's bet, your job market's future. And this AI build-out is happening on top of something else, a foundation that's already carrying serious weight. Think of it like a pyramid. Families at the bottom, businesses in the middle, governments on top. American households are sitting on nearly $19 trillion in debt. Student loans approaching $2 trillion, with close to 10% of borrowers more than 3 months behind. Let me paint you a picture. There's a family in suburban Ohio. Sarah's a project manager. Her husband Mike works in IT. They've got a mortgage, 2 car payments, credit card balances they can't quite clear, and their oldest kid's student loans just came due. On paper, their debt-to-income ratio looks manageable. In practice, there's no room for error. One unexpected medical bill, one layoff, and the whole structure starts wobbling. Now multiply Sarah and Mike by millions. Context matters here. Household debt as a percentage of the economy sits well below where it was during the financial crisis. The aggregate picture isn't screaming emergency. But that's the prime borrowers, people with good credit and stable jobs. Delinquencies among riskier borrowers? Climbing steadily. The system has a 2-tier structure, and the bottom tier is showing cracks. Corporate America tells a similar story. Business debt is approaching historic highs, with commercial real estate looking particularly ugly. Office space delinquency has crossed double digits. All those empty downtown towers that were supposed to be worth billions, now sitting with unpaid loans because nobody needs that much office space anymore. Nearly $1 trillion in commercial real estate debt matures next year. Someone's got to refinance that at today's higher rates. Not everyone will make it. Then there's private credit, the shadow banking sector that's basically doubled since 2019. Money flowing outside traditional banking regulation, with less transparency and higher leverage. Default rates are already climbing into worrying territory. This is the new subprime. Different packaging, same fundamental problem. Zoom out to the sovereign level. China's debt compared to its entire economy is projected to hit levels that would have seemed insane a decade ago. Europe's running fiscal deficits above historical norms. The US is running twin deficits, fiscal and trade, pushing yields higher and making the whole structure more expensive to maintain. Hedge fund leverage? At levels we haven't seen since right before things got interesting in 2013. And here's the strange part. By some traditional measures, the system actually looks okay. Total private debt relative to the economy is near historic lows. But leverage is hiding in new places. Private credit, non-bank lenders, complex structured products that don't show up in the old statistics. This is the platform on which we're building a multi-trillion-dollar bet on AI. A system already carrying substantial obligations, now taking on even more, betting the returns will justify the risk. What could go wrong? Then there's crypto, threading through it all. The market peaked above $3 trillion back in late 2021, then lost 2/3 of its value when Terra USD collapsed. By late 2025, it had bounced back toward those highs, then immediately dropped 30% within weeks. Bitcoin swings 4 times harder than stocks or gold. The crypto casino, as skeptics call it. You might think this is just gamblers playing with internet tokens while the real economy does its thing. Except crypto stopped being separate years ago. Stablecoins, those supposedly stable digital dollars, now represent hundreds of billions in market value. And here's where it gets interesting. They're backed by short-term US Treasuries, a lot of them. One estimate suggests that in a stress scenario, stablecoin issuers could dump $300 billion in government bonds onto the market. The casino isn't isolated anymore. It's wired directly to government bonds, to treasury markets, to the foundation of the entire financial system. When people panic sell their stablecoins, real government bonds have to get liquidated to pay them out. The numbers tell the story of integration. Crypto ETF assets have more than quadrupled in just a couple years. Tokenization of traditional money market funds is becoming real. The supposedly separate world of crypto is now connected to treasury markets, traditional finance, and the broader debt structure. Think about Mike from our earlier story. Maybe he's got some Bitcoin in his portfolio, thinking it's diversification. He doesn't realize that a crypto meltdown could trigger treasury liquidations that affect his municipal bonds, his pension, his job. Ownership concentration is extreme. A tiny number of addresses control a massive chunk of all Bitcoin. Leverage in crypto trading can hit levels that would be illegal in traditional markets. We've seen stablecoin runs, reserve mismatches, spectacular implosions of major exchanges. Nation-states are stealing billions from crypto platforms. This isn't a mature, stable system. It's volatile, concentrated, and now interconnected with everything else. Yet the believers make their case too. Some argue crypto is the new gold, a non-sovereign store of value for a digital age. The valuations might exceed any rational fundamental, but with proper regulation and custody solutions, maybe high valuations can be sustainable. The key is harnessing the innovation while neutralizing the threats. Under that view, crypto's volatility is just the price of admission to genuinely transformative technology. A feature, not a bug. So here we are, 3 layers stacked on top of each other. An AI infrastructure build-out financed heavily with debt, happening on top of a financial system already carrying significant leverage, with crypto threading through it all via treasury holdings and institutional adoption. Each layer has its own logic, its own believers and doubters, but together, they create something more complex than the sum of parts. If AI delivers on its promises and becomes genuinely transformative, maybe the leverage gets justified by massive productivity gains. The debt gets serviced, the investments pay off. Crypto finds its place as a regulated asset class. That's the soft landing. The scenario where we look back in 10 years and laugh at the people who called it a bubble. Or we get something messier. Commercial real estate defaults trigger stress in regional banks. A crypto blow-up forces emergency treasury liquidations. AI companies miss revenue targets, and the equity concentration in major indices creates a brutal sell-off. Not a single apocalyptic event, but a cascade of smaller fractures propagating through different parts of the system, each one making the next more likely. Sarah and Mike's carefully balanced budget suddenly doesn't balance anymore. The harder scenario doesn't require predicting which domino falls first. It just requires recognizing that when you've got elevated valuations in AI stocks, significant leverage across multiple sectors, and crypto volatility all interconnected through debt markets, the system's got plenty of ways to surprise you. The question isn't whether any single piece is a bubble. It's whether we're looking at one integrated structure where the pieces amplify each other's risks, where stress in one layer doesn't stay contained but ripples through the others in ways we won't see coming until it's already happening. 3 layers, $3 trillion bets, one financial system. The smart money is convinced this time is different. History suggests it never is. So here's the question for you. What do you think breaks first? AI valuations, crypto, the debt structure, or something else entirely we're not even watching?